Eugene Fama is on the board of directors of Dimensional Fund Advisors, is a member of the investment committee, and serves as an investment strategist. Professor Fama received his PhD from the University of Chicago in 1964. He also holds an MBA from the University of Chicago, BA from Tufts University. Professor Fama is the Robert R. McCormick Distinguished Service Professor of Finance at the Graduate School of Business of the University of Chicago. He's the author of 2 books and numerous articles. He's an advisory editor of the Journal of Financial Economics. Much of Professor Fama's research has been concerned with market efficiency and its implications for passive versus active portfolio management. Professor Fama, you are arguably the best-known financial economist in the world. How did you become interested in finance and in economics?
That's a good question. I was an undergraduate at Tufts, and I was majoring in Romance languages. And I was inquiring around as to what people made. I had a child already with another one coming, and I inquired around what people made in Romance languages, and I quickly switched to economics. But I got a little bit tired of studying other people's views of something that had been written several hundred years ago. So I thought economics was a little more exciting once I got into it.
And what was your first experience then with the stock market?
Oh, that's a good one. You won't believe this, actually. I worked for a person whose service was to devise ways of beating the market based on past patterns and price series. So my job was to, I was pretty good at statistics even then, was to devise ways to beat the market. And I was very good at it. Every day I came up with a new way to beat the market. But it always worked on the old data, it never worked on the new data. So then I thought there must be something wrong with this approach. And I guess maybe that was the germ of efficient markets there.
Well, actually you were frequently referred to as the father of the efficient market theory. When your paper, Random Walks in Stock Market Prices, was published in the early 60s, what was the reaction of others in the academic community?
Well, in the academic community, I was, people had already been doing work like this. I think maybe what I did was I kind of codified the concept and made it a little more precise than people had talked about it until then. And I stayed at it longer. Other people got bored with it and went on to other things. But among academics at that time, there was a lot of interest in coming up with tests of how markets worked. This was, it's kind of serendipity. This was the time when the first reasonably sized computers were around, and stock market data was fairly easy to collect. So the natural thing to apply the new computers to was seeing how markets worked. As I said, I had already had some experience with this as an undergraduate, so it was a natural thing for me to pursue. But it wasn't something I just dreamed of. There was a lot of interest in it already at Chicago, and there were a lot of people coming to Chicago from other places, visiting, talking about how one would go about doing this kind of thing.
So the academic community embraced it?
Yeah, there were some, naturally there still are, exceptions, but it was like having a computer and being able to do all this stuff was like, having a new toy.
What about those in the investment industry, the money managers? Were they equally as receptive?
I don't think so. To this day, they have not remained all that receptive. I remember I used to get outraged when I was a child when I would get quoted in newspaper columns and they'd get it all wrong. And they had no idea really what it was all about. And Jim Laurie said to me, don't worry about what they say, just being mentioned is what counts. But at that point in time, there was no such thing as passive management. There was no such thing. Everybody thought you could beat the market, although there was no evidence that anybody could, and nobody had even tried to study that.
So you were working outside of the beliefs of beating the market?
Of market participants, for sure, right.
What about the efficient market theory? What is it, and why is it important to investors?
It's a very simple concept. It says that prices basically reflect all available information, so that in a strict view of the theory, it would say it's basically impossible to beat the market. You're always paying a fair price, basically. That's the simple concept. Is the price is always fair. That's an important concept for investors because it says they're always paying fair prices. So their task is simplified. They basically just have to decide what kind of risk-return trade-off they want to be involved in, how much risk they want to take in order to get more or less expected return. But they don't have to worry about picking stocks because they can operate under the presumption that the stocks will be fairly priced.
Do you believe enough investors have heard of the efficient market theory?
I suppose it would be, in this day and age, we've educated so many MBA students, it would be, it's hard to believe that any professional investor hasn't heard of the concept. Man on the street, I don't know. I guess people walk by me all the time and don't recognize me, so I guess there must be many. There are many people who haven't heard of it.
When market prices change dramatically over a relatively short period of time, October 1987,
Right.
an example, many investment professionals like to say that such price movements are proof that markets are not efficient. How do you respond?
I don't think you can ever say much about a particular price change, but the 87 crash is one lots of people point to. My response to it is, some people think it's facetious, but I don't think it really is. We've had two big crashes in this century. One was an underreaction to subsequent economic events in 1929. The economy turned out to be even worse than the initial crash would have predicted. The last one turned out to be a mistake. So 1 out of 2, it's about exactly what you expect from an efficient market. But I don't know how deeply you want me to go into this.
Please go ahead.
This is a common notion that there's too much noise in prices, basically, and that these big price changes are an indication that there's too much noise. Well, statistically, that has a straightforward implication. What it says is that the volatility of prices should go up less fast, more slowly than the horizon that you're looking at. So monthly returns shouldn't be 30 times as variable, or the square root of 30 times as variable as daily returns. An annual return shouldn't be square root of 12 times as variable as monthly returns. But in fact, when you look at the series, it turns out to be the case that the volatility does go up at the horizon, more or less exactly as you'd expect if there were no noise in the series. So that's why I say you can't look at individual price changes. It's the arrogance of people to think that if I can't explain an individual price change, the market has to be inefficient. Why should you be able to explain it? Who knows what went into that price? But basically, what you want to know in the long term is the volatility erased, so that long-term returns are much less volatile than would be predicted based on the volatility of short-term returns. And that doesn't turn out to be true. Long-term returns are about as volatile as you would predict based on short-term returns and based on the proposition that there is no noise in the series.
Now, with so much money pouring into index funds these days, and we touched on this a little bit, can we assume that the efficient market theory is being embraced by a large segment of the investing public?
Well, I don't know what the proportions are. Certainly, DFA is an example. There's some segment of the investing public embracing it. Vanguard's another example. American National, Wells Fargo has played both sides of the game, I think. But I don't know what the proportions would be at this point. My guess is that about 40% of the money that's under management is passively managed. In reality, much more of it is passively managed. It's just that people are paying active manager fees for passive management. For example, if you take a big pension fund that has many different managers, they're all being paid to produce active management, and then when you look at the overall portfolio, it might look very much like the market. So basically what they've decided to do is pay 1% to buy the market. I know it's quite subtle logic in doing that, but so there's much more effective indexing than you would see by the looking at how money under management is allocated across active versus passive managers.
Well, are you satisfied with where it is right now?
No. I would like to see much more, naturally, under passive management, but I've been saying this for 35 years now. It's had some impact, but not as much as you ever would want, right?
Well, your analysis of stock markets returns that led to the three-factor model has often been cited by critics that your own research shows that markets are not efficient. How do they arrive at that conclusion, and what's your response?
There are people who think, not that the three-factor model is an indication of a market inefficiency, but that the book-to-market, the relation between book-to-market equity and average return, that's a manifestation of a market inefficiency. Where our three-factor model quarrels with that is we say, no, that's not the case. This is a real risk that you can't diversify. And that's what you're getting compensated for. So there is still an ongoing debate in the literature about how you interpret this effect. So I guess that's what people quarrel with is that we haven't identified what fundamental thing is of concern that would lead to the book-to-market effect. We talk about distress because high book-to-market tends to be associated with distress. But the way Ken talks about it, and I think he's right, is that basically what you're looking at is looking at something over price. So what you're doing in looking at something over price is you're looking at the information in the price about expected returns. So when prices are low relative to fundamentals, that means expected returns are high. And every rational asset pricing model would say that's a manifestation of some sort of risk. And that's our view of it. If it isn't, we might as well forget about it, but because it should go away. But everything we've done says it doesn't go away.
Mm-hmm. The study of behavioral finance seems to be in vogue these days.
Right.
And it's attracting a lot of attention. Is there any merit to their argument? And if not, why do so many of your colleagues continue to waste their time?
Well, my good friend Dick Thaler, I'm going to talk about this tomorrow actually at the seminar. I can't, they've allocated me an hour to talk about behavioral finance. That 7 or 8 minutes should be enough. But my good friend Dick Thaler is kind of the guru of behavioral finance. And every time he walks down the corridor, I ask him a question, and the question isn't even it's not a complete question, but a person on the street wouldn't know what was going on. My question is always the same, though. What is it? He knows what it refers to. It's behavioral finance. And the reality is they haven't defined they haven't defined the area. What it is at this point is, unkindly speaking, is just dredging for anomalous-looking things in the data. But the fact is that even in a perfectly efficient market, every data set will yield anomalous phenomena, just on a strictly random basis. So that's not evidence for or against anything. If you don't have a specific view of what behavioral finance is and the way it manifests itself in the behavior of prices and returns, you don't really have anything to work with. Because everything you observe really can be rationalized in the context of an efficient market. For example, one thing that I'll talk about tomorrow is all of these studies in behavioral finance basically look at how prices react to different kinds of announcements. So sometimes it seems to be the case that prices underreact, sometimes it seems to be the case that prices overreact. But that's exactly what you'd predict in an efficient market. You're going to see drift one way or the other, but it'll be random. So if you don't have a theory that predicts when it's going to underreact and when it's going to overreact, you don't have anything. Looks to me like an efficient market, just a random price behavior. So that's where I have a paper actually coming out in the Journal of Financial Economics called Market Efficiency, Long-Term Returns, and Behavioral Finance that kind of puts out this challenge to them that it's time to stop just dredging the data for these anomalies. Now you got to start telling me some kind of coherent story, because when I look at the anomalies and put them all together, that's what this paper was all about, putting them all together, they just look random. Looks like something you'd expect coming out of a lot of data dredging of prices that were generated by an efficient market.
Since 1982, the stock market, as measured by the S&P 500, Professor Fama, has had a phenomenal run. Do you believe there'll be a reversion to the mean?
I don't know what you mean by reversion to the mean. I'm sure there will be a big negative return. Quite sure. The question is, when will it happen? Will it happen after the market triples again? Or will it happen tomorrow? My expected value always is the historical return. But there are always downturns. There are always upturns.
Do you call it a correction?
A correction? No, that's a bad word. Correction is only something you can talk about with hindsight. An efficient market person never talks about a correction. It may turn out to be a correction, but it wasn't something you would have predicted in advance as a correction. How many people since 1982 have been saying that the market is too high year after year after year? I'm glad I stayed in. That was one of the benefits of being an efficient market person all this time. I never got out. There's so much mispricing out there. How is it that all the smart money can't seem to find it? My answer to that is simple. It's not there. The prices are right, but there is no evidence that active managers add value. I'll go back to Warren Buffett because maybe he can do it, okay? But how does he do it? He doesn't claim he can pick 1,000 stocks or 100 stocks. He claims he can pick one every couple of years. That may be, for a very good person, that may be as good as you can do. But even he, who is taken to be the prime example of a successful active management, doesn't claim he can do it in general. He just claims he can do it in very few particular cases.
Professor Fama, individual investors seem to act on emotion. They sell when things are bad. They go buy high when things are good. Are investors an inefficient lot while we're trying to say that it's an efficient market?
Well, there's certainly irrational behavior in every market, but the issue is, what is the effect of that behavior on prices? My study of the past data says those people aren't the people that make the prices. Even the people behaving irrationally would be people introducing lots of noise into the prices. So to go back to where we started, what you'd expect to see is much less volatility in the long term than would be predicted by projecting the short term. But you don't see that. So this irrational behavior somehow must be washed out by rational behavior on the part of other investors. Now, nobody really understands the process by which the markets worked. Nobody understands the nuts and bolts of it down to that particular microeconomic level, the individual person doing the buying and selling. And I don't expect to understand that during my lifetime. So far, we haven't seen much evidence that it has any noticeable effect on price formation. Why that is the case? Well, that says I know more about price formation than I do. I don't really know why.
One more thing. In the July 6, 1998 issue of Fortune magazine, an extensive profiling of dimensional fund advisors included this on Professor Fama. On visits to DFA's California headquarters, he, Professor Fama, wears a special beeper that goes off when the wind is right for windsurfing. Once alerted, the 59-year-old Fama packs up his sailboard and heads for the beach, or if he's stuck in a meeting, he exhorts the participants to hurry up. Do you really carry a pager that alerts you if windsurfing conditions
Well, I tell you, this is a very expensive interview because at this very moment, it's blowing its brains out there. And I would be in the dunes in Indiana at this very moment if we weren't doing this.
So you do, just as the Fortune magazine
I do in California, sure. Yeah. Only I don't say, let's get this meeting over with. I say the meeting is over.